financial engineering is the discipline to apply mathematical or computational approach to financial sciences. As you know, as an investment firm, the general approach is always to invest your client's fund in such a way that it maximizes your return, minimizes your risk, and minimizes your cost, right? Now, how do we use the help of mathematical models, formulas, and computer programs to do that very effectively? If you have heard the words such as quantitative investing or mathematical finance, they pretty much mean the same thing. And this is also a relatively new field. A lot of the foundational work were established in the mid-90s, and there were a lot of major breakthroughs in the mid-2000s. And even as we speak today, people are still coming up with newer and newer models, as I will show you later. Okay? The outline of today's talk will be, first I will explain to you the difference of quantitative investing and traditional investing, and I will give you 3 examples of application of financial engineering in the areas of portfolio construction, portfolio implementation, and derivatives pricing. And hopefully by then, I've piqued your interest a little bit on to how to become a financial engineer. Okay? First, the difference between quantitative or traditional investing. Traditional investing is also commonly known as fundamental investing. So what does it look like for you to be fundamental investment manager? Well, you usually make your investment decisions from your own decision. You, for example, if the manager wants to buy the stock of Coca-Cola, it's because he thinks that the price of Coca-Cola stock will increase in the next month or the next year or so. Right? He makes that decision because he believes that the current state of the firm predicts future performance. For example, he might look at the Coca-Cola report and decided that he looks at his debt level, cash level, his operations cost, and so on and so forth, and he decided that Coca-Cola is worth buying. His day is usually focused on reading the operations and strategies from the reports, and he follows the news heavily. In contrast, a quantitative investing manager, he believes that the past data predicts future performance. So when he buys Coca-Cola, it's because the computer thinks that Coca-Cola will increase in the future. And the computer knows that because the computer looks at the past data, as evidenced by the numbers such as earnings per share, price per earnings, or even the beta, the correlation of that stock with the market movement, or even the current interest rate. The manager comes in every day to the office. Well, of course, he has to follow reports and news as well. But he also is primarily concerned with how is my model doing today? What is wrong? Why did it not do as well? And how can I refine my model better? This is an example of a fundamental manager at work. As you can see, his monitor is basically he's checking the reports of all of the companies he's following. Whereas the day of a quantitative investment manager looks a lot like this, and his monitor looks a lot more like this. Right? And I will explain to you what is it that he's looking at later. So the first example that I want to show you is this area of portfolio construction. Now, I want to show you a very simple game or example. If you have 2 stocks, stock A with 20% return and 15% risk, and stock B with 10% return and 30% risk, which one would you choose, A or B? A, of course, right? Because generally we want high return and low risk. Now, what about this? When A has better return than B, but it also has better risk, which one would you choose? Yeah, A or B, right? It's not clear. Some people want higher return and some people want higher risk. There's no clear trade-off here. But fortunately, we don't have to choose just one. We can choose a combination of A and B. For example, you can invest 60% in A and 40% in B, or 30 and 70, or 80 and 20, and so on and so forth. Right? Which brings me to this plot called return risk plot. Those of you with background in economics might have seen this. This axis represents your risk, or standard deviation. And this axis represents your return. Right? And what we want is high return and low risk. So we generally want to get into this corner. But if your stock A is right here, and your stock B is right here, and you choose any combination between A and B, you will end up with this blue curve. Right? For example, if your stock is 50-50, it might be somewhere around here. If it's mostly A, maybe it's around here. Then how can you go beyond? This is allowed if you are allowed to short sell. For example, you can short sell your stock B and use the money to buy stock A. It's very risky, but it promises better return, hopefully, because as you can see, the risk is very high, but it's also high return. Now, this blue curve represents the potential of the portfolios that you can invest in if your options are either A or B or any combination thereof. How do you choose the exact point for your client? Right? The answer depends on your client's risk aversion. So let me talk about risk aversion a little bit. Generally, clients or human beings are risk averse in that we really hate to lose money. Right? And we really hate it in such a way that losing $100 hurts a lot more than earning $100. So it's not symmetric. Or it's not linear as well. Losing $200 hurts more than twice of losing $100. That's why you really want a lot of increased expected return in guarantee of each increased unit of risk. This is why the client's risk aversion curve is usually very upward sloping, very convex. The steepness, though, it depends on each particular client. Some client may be very risk averse like this. Some client may be a little bit more okay. And what we do is we take measurements of the client's risk aversion, and we shift it up and down until it touches, it's tangential to our potential portfolio. And this point of tangency is your chosen portfolio for that client. For example, for this red client, then we will choose this portfolio, something like 80% A or 20% B, for example, and so on and so forth, right? Now, if I throw the third security into the mix, so you've seen that this is stock A and this is stock B, and now I put stock C in here. The blue curve here was the curve that we saw earlier, but this red curve is your new curve with the third stock thrown into the mix. So as we're adding more and more stocks into the mix, our portfolio will shift a little bit more and more closer to that corner. Why? Because the universe of investable portfolio increases. Now we have more possibilities than just A and B. Right? This curve is called efficient frontier because it represents the best return risk combination if your choices are A, B, or C. So anything below that curve is not efficient. For example, if I'm here, I can get better return for the same risk, or I can get less risk for the same return. Okay? This is another example with 4 securities. The blue curve here is with 4 securities. And I added the 6 securities here to get 10 total securities, and this is the 10 securities. As you can see, as we add more and more securities into the mix, your curve will shift a little bit closer to this corner. And this is another example with 300 securities. Your curve looks like this. And this is impossible to determine by hand. You need a computer program to compute this, right? The typical quantitative fund usually invests in 300 all the way to 1,500 securities. It is not possible to come up with your own curve. You rely on a computer program to do this. The traditional investment manager that I know, sometimes they invest in 20, 30, or some ambitious ones might have 50 securities, but they're not going to be able to do 300 like this. Now, in theory, this is really easy to compute with a computer because it's essentially a quadratic optimization problem. Microsoft Excel can do it really fast if there's no other constraint, if you're allowed to invest freely in these 300 securities. But the problem is, of course, there are a lot of constraints that they give us. And I'm going to show you some of the real examples that I face on a day-to-day basis from our clients. For example, they don't want us to invest in any tobacco or genetic engineering companies for moral reasons. Some clients also want minimum % of their fund invested in eco-friendly companies. Some of them also, and this is very often, is very common, some of them want minimum % of exposure to certain country, like I want minimum 20% exposed in Europe, or maximum Japan, minimum certain % in Middle East. and so on and so forth. Or certain sectors, such as biotech, or industrial, or manufacturing, right? So they are investing in us for a very specific purpose, and they say, I want to expose myself to the Japanese market, so I want at least 80% of my money invested in Japanese yen or in Japanese market. So we have to respect that. We have to obey all of these constraints. So as a result, your efficient frontier is unique for each client because every single one of them have different constraints. That's why sometimes it might be expensive to compute each frontier separately. So we have to be clever in not computing every single one from scratch, but we can save pre-computations or partial results whenever we can. And that's why there are a lot of research on how to still achieve total correctness of your efficient frontier while not really brute forcing, not really using brute force to perform your calculations. The next area of application that I'm going to show you is portfolio implementation. Now that we know our ideal portfolio, now that we know our efficient frontier and where in there we should be, this is our ideal portfolio, how do we get there? Today, our holdings is here, and our ideal portfolio is here. How do you bridge the gap, right? The obvious answer is just take the difference and trade it. Of course, if you do that, you will get to your ideal portfolio. But a lot of times, it does not work because we'd be moving the market. It's very typical for us, for example, to get into your ideal portfolio, you will have to buy 1 million shares of IBM. There is a lot of IBM. And as you're buying that much, your price will increase. The IBM price will increase because we buy it so much, right? Now, if the IBM price increases as we're buying it, maybe IBM is now too expensive. The return is not as high as how we calculated it. It's no longer as attractive. Maybe it shouldn't be in our ideal portfolio to begin with. And likewise, if you're selling too much, the price will go down, and maybe that stock should have been more attractive than it shouldn't have been sold to begin with. Right? So we don't want to move the market if we can afford to do it. Another approach that you can think of, maybe, okay, if your trades are too big, maybe we can split it 5 days. You can trade it 20% every day for 5 days, and hopefully we don't move the market that way. In theory, it should work, but in practice, it doesn't work again, because different stocks have different liquidity. When you're trading 1,500 stocks, some of those stocks are going to be very small companies, and those companies are not traded every day. So just because you want to buy it does not mean someone is going to sell it. And if we see on the first day someone is selling 60% of what we want, what are you going to do? Are you going to buy only 20%? But it may not be sold again tomorrow or the day after. But if you buy 60%, you might move the market. So how do you make that decision, right? And often there's less than 100% execution rate. As I said, just because you send that order to the market does not mean someone is going to sell you that stock. So maybe we don't know if we can get to our ideal portfolio perfectly there. Right? Some trades are also really small, so there are a lot of ticket charges. This is a concept where the broker charges us a set amount of money for each trade that you do, regardless of how big or how small that trade is. So for example, if I have really small trades and I split it over 5 days, then you're going to incur ticket charges over 5 days. And because the trades are really small, then these ticket charges are no longer a trivial amount. It's actually a significant percentage of your trades. Right? So in the bottom line, we have sometimes to be satisfied just to get close enough to our ideal portfolio. If the ticket charges are too high, maybe we don't want to trade that stock to begin with. Maybe we'll just trade as much as we can without it being too expensive, but we don't get to our ideal portfolio. So this is called the trade scheduling problem. Given what we need to trade, and often a large amount, how do we schedule our trades over several days? We must be mindful of your cash balance. For example, if on the first day you send a lot of your buy trades and you don't send a lot of your sell trades, you're going to buy a lot, but you're not selling to make any money. So you don't have cash to pay for your buy trades, right? You'll be overdraft. Or on the flip side, if you sell a lot but you don't buy, then you'll end up with a lot of cash. Now, what's the problem with that? What is the problem with having a lot of cash in your investment fund? Anyone can tell me? Right? The problem is because the client usually gives their money to us because to invest it. If they're content with us just having cash around, maybe they would have put it in the bank to begin with. Maybe they will have better interest rate than us. Right? So the general industry standard is we want to at least invest 98% of our clients' fund at all times. Also, regional timing. For example, I'm based in Boston. Right? The US market closes at 4 p.m. Boston time, and the New Zealand market opens at 6 p.m. Boston time. Often our execution data does not come back in until 4:30, but we have to send the trades by 5:30 to prepare the traders in New Zealand accordingly. So we have less than an hour to prepare our trades. Right? And you can see how this window interacts with your cash balance in a very complicated way. If I send a lot of trades to the US, and a lot of my buys are executed, but a lot of my sells are not executed, I have to be mindful of my cash balance when I send it to New Zealand. Then I cannot send too much buy trades. I have to send mostly sell trades to New Zealand. And then Hong Kong and Shanghai and Japan open up next, and then India is the next one, and so on and so forth. Local holidays. We have to be mindful that not all markets are open on the same days. Fairness. If, for example, if a lot of our clients want to buy IBM on the same day, and then we send all of client A's IBM trades on the first day, and then we send client B's IBM trades on the second day, that is unfair. Why? Because if IBM prices moves too much between first and second day, then if the IBM price increases so much, then client B is disadvantaged. So we have to send roughly an equal percentage. The client parameters. So everything that I said before, the tobacco constraints, genetic engineering constraints, Japanese exposure, European exposure, those have to be observed even as we're observing all of these other things, right? And this is another complications with the regional timing. If the executions from the Europe comes back in around 10 a.m. US time, for example, and I find that I'm overexposed to a certain industry, then I have to send my US market to correct it back, to get it back into compliance. Right? And when it's 10 a.m. US time, then I have less than 2 or 3 hours to prepare for my US trades. Costs. There are a lot of commission or fee charges that I mentioned before, right? Odd lot charges, for example, in the US, we have to trade in multiples of 100 shares. So if you trade, for example, 130 shares, then the 30 shares that you trade is going to be very expensive. The opportunity cost, how do you know these trades these shares are going to be on the market tomorrow, right? Multi-listed stocks. For a lot of oil companies that I know, they are listed in New York and Amsterdam, Frankfurt, and London, for example. Maybe we want to choose the cheapest one to trade in. However, if you're not careful with your exposure level, then maybe you're overexposed to that European market, right? The bottom line is that this is a very complex problem, and there are a lot of moving parts, and there are a lot of constraints. So how do we schedule our trades in such a way that we don't violate all of these constraints? And the problem is it has to be fast, as I said before. The timing regional window is pretty tight. We usually try to model it as an optimization problem where our objective is really close to getting as close as we can to our ideal portfolio with minimal cost and minimal time, where our requirements become the constraints, right? In theory, this is a nonlinear optimization, and this can get very expensive to compute. But in practice, usually linear solution is good enough, especially because we're running against time limitations. And due to the size of parameters, if we're not careful with the way we model it, it might take a really long time. For example, we can, for the day's worth of trade, the brute force approach sometimes takes to 6 hours to compute. But we don't have 6 hours between the US market close and the Oceania open, right? We have to shift it down. So we have to weigh our correctness against our execution window. So the trade-off between correctness and running time, this is an ongoing area of research again. People are trying to discover how can we schedule our trades more efficiently. In the traditional investing world, your manager really has to check every single one of those constraints. The picture of the traditional investing that I showed you earlier, or a friend of mine, a colleague of mine, he's actually a traditional investment manager. He has literally 30 Excel spreadsheets open, and he has to switch back and forth to make sure none of his constraints are violated. But in the quant world, this will never happen. You don't have to check your constraints. Why? Because your constraints are baked into the requirements. It will never be generated. The trades that violate your constraints will never be generated to begin with. Right? So just an anecdotal example. In the quant investing world, we can handle upwards of 60,000 trades per day. There's no way a fundamental manager can do this much volume. Right? The third example of application is in the area of derivatives pricing. Derivatives is a right, but not an obligation, to buy or sell an asset at a specified time in the future for a certain price. So for example, I have a piece of paper that says, the owner of this piece of paper can buy the stock of Coca-Cola for $30 a year from now, right? How much would you pay for this piece of paper? How much is this piece of paper worth? Well, it depends on the price of Coca-Cola today. But more importantly, it depends on how much you think Coca-Cola is going to worth a year from now, right? So it really depends on two things. First, how far away it is, and how much is Coca-Cola today, and what's the trend of Coca-Cola that you think is going to go. And the underlying asset, it does not have to be stock. It does not have to be a stock of Coca-Cola, but it can be commodities such as corn, wheat, barley, right? Oil. It can be interest rates. It can be currency rates. For example, if I want to protect my exposure against the Japanese market or the Chinese yuan market, then I will enter into derivatives pricing with the Chinese currency exchange. These derivatives have been around for more than 30 years, but it's only recently gaining popularity. Why? Because only recently people know how to price it. For example, if I'm a farmer and I'm really worried that if I'm a corn farmer and I'm really worried that the corn price might fall tomorrow, then what do? Then I enter into derivative contract for me to sell corn at a certain price a year from now, and that's when my harvest is due. Right? If the price of corn happens to fall below that price, then at least I'm protected. I can always sell my corn at this price. But if the price of corn happens to be higher than that, then I don't have to exercise. Remember, it's a right but not obligation. I don't have to exercise my option. So I can always sell it at the current market rate if I want to. Right? But for the farmer to do that, then he needs to know how much this contract of corn option is really worth. Right? One simplest example to do it is by modeling your stock price as geometric Brownian motion. This is a very popular model for stock price. This is an example of geometric Brownian motion. Those of you who have seen a stochastic process might have recognized that this is a Wiener Brownian process. And people like it because this only assumes positive value. As you can see, there's an exponent here, so it will never be negative. And it has the same roughness or same jaggedness, if you will, as the actual stock prices in the market. This is an example of another Brownian motion, and this is the same Brownian motion from the same equation being realized, right? And the main beauty of this Brownian motion is that it's really easy to solve analytically. And one example where people have solved it analytically is in this Blackshells equation. As you may recognize that this is a partial differential equation where C is your stock price, your option price. It has to fulfill this equation at all times for it to be a fair price. Now, you might recognize it with, similar to heat equation in physics. Right? Depending on your kind of options, whether it's a buy option or a sell option, whether your strike price really depends on the price, on the time of maturity, or we have this thing called Asian style where it really depends on the average daily price between today and the time of maturity, and that's why you have this average term here. Right? You have different boundary conditions depending on how much your option gives you at the time of maturity. Now, when you have a partial differential equations and you have a boundary conditions, you can solve it. In theory, you can always solve your function. The beauty of Blackshells and geometric Brownian motion is that it's been solved analytically in a closed form formula. right? This may look complicated, but all this means is that all of the things here are known to us. So this is just a matter of putting all of those numbers into the calculator, and then you can get your fair price option. Blackshells get a Nobel Prize in 1997 for this discovery, right? But in practice, this is not a very realistic model. Nobody does it in practice today, at least not any of the big banks that I know. And the main reason is that, again, geometric Brownian motion assumes a constant volatility value here. But this is an example of the volatility plot for a single stock for different maturity rate and different strike price. Right? As you can see, this is very much not a constant. It should have been a flat surface, but it is not a flat surface. So yes, volatility in the market is not constant at all. Right? And the true market behavior does not look Gaussian. If you take the log of this equation, it should look Gaussian because of this Brownian term here. But in practice, it looks more leptokurtic, meaning it has very skinny peak and higher peak, but flatter tails. So in a way, this is not a very realistic model. Then why did they get a Nobel Prize? It's mostly because they have this new insight that options pricing is eventually a solution to a PDE, a partial differential equation. Right? This is not something that nobody realized before then. Right? And because they realized this, even if the model is not realistic, people are trying to come up with better and better model because they realize, yes, we can actually come up with better model, but, and we can turn it into partial differential equations to solve. I'm going to give you some of the example of those models. Heston model is a slight tweak to geometric Brownian motion because it assumes that the volatility is not always constant. This is very realistic. You can model it to fit the market perfectly, but sometimes it's really hard to solve this analytically. You have Ornstein-Uhlenbeck process where you might recognize this similar to the spring movement equation in physics. If you know the spring, when I disturb it, it always tries to go back to its original state, right? And it has this equilibrium term here, the mu. That's why people like this model to simulate commodity prices, such as wheat or barley, because they think that while prices of wheat and barley might fluctuate, it usually goes back to the usual level. Oil is not so much as you have seen recently. Currency exchange rate usually is also tends to go back to its equilibrium state. Right? And there are a lot of many models being researched to fit different asset type, and one of them is interest rate. Fasicek, he came with this model in the mid-'80s, and for the most part, it's pretty realistic. But the problem is that this model allows negative interest rate. If you actually work out the math and run the simulations, sometimes you can get negative interest rate. So people didn't like that. How can interest rate be negative? So they come up with the new model by Cox, Ingerson, and Ross that tries to fix that flaw by introducing several additional terms here. And people thought that this is an improvement because it does not allow interest rate. It's impossible because if you work out the math, it becomes an exponent. It's just similar to geometric Brownian motion. Right? But is it really an improvement though? Right? Because negative interest rate in a surface, it does not make sense. And it happened once in Switzerland in 1977, and people thought it was a fluke. It should never have happened, and it's impossible. But it started happening very often recently, all around Europe, right? And it happened again a few months ago in Sweden in March. And even Janet Yellen, the chairman of the US Federal Treasury, she said, it's not impossible for the US if our economy does not improve. So turns out negative interest rate is not only possible, but it's actually common, and it's been happening for a while, since 2009. So people are taking second look at this model. Cox, Ingerson, and Ross is no longer thought an improvement, but people are thinking of Fasicek model again, or maybe trying to improve Fasicek model, because when did it go to negative rate? Is it under specific circumstances, or was it just randomness? Right? So the point here is that there are new models being proposed as the global market changes. And we have a lot of models. So what's the point of all of these new models that people are proposing? Well, as I said before, and this is why Blackshells got a Nobel Prize in 1997. They found a way to convert the model and option pricing to partial differential equation. This is called the Fineman Cuts formula. For those of you with background in physics, this is the actual formula being used in quantum physics. This is your pricing model, be that your Heston model or geometric Brownian motion. And then this is your option payoff, the European style or the Asian style. And you can take all of this formula and combine it to come up with a PDE here. And the PDE sometimes can be solved analytically, as in the case of Blackshells. But sometimes you cannot solve it analytically. But the solution of this PDE is guaranteed to be your fair options price if your model is correct and your option payoff is correct. Right? So how do we solve this PDE then if you cannot solve it analytically? The first technique that you use is Monte Carlo simulation. This is where you really run your price process stochastically by simulating it a lot of times. Right? As you can see, each curve here, each path is the movement of a single stock price, and at the end, at the maturity time of the option, you gauge how much is that option worth. For example, if the Coca-Cola price rises up to 90 and the strike price was 30, then my option is worth $60. And you run it maybe a few million times and you take the average. And that should be your expected value of the option today, right? So that should be your fair price of the option today. So in theory, this is easy. You just run it a lot of times and you get your fair price. But what's the problem here? There's too much variability. How can you trust the answer? I know from personal experience that when you run your Monte Carlo 3 different times, right? Like a million times, another million times, another million times, you get different answers every time. And the answers are not, they weren't close. It's like 20, 50, 10. Which one do you trust? And they are wildly different. Right? The problem is because the error rate does go down with the number of simulations you do. But sometimes it goes down really slowly. It's true that when you run more and more millions of times of simulations, your error rate will go down. But sometimes it goes down really slowly if you're just doing it by brute force. So people come up with other techniques to reduce the variance. It's called stratified sampling, exponential tilting. Basically, you look at the formula of what you're trying to simulate, and are there mathematical properties in the formula that we can exploit in the way we generate our random numbers so that it's not too random, but it's still realistic, right? And as you can see, when one of those is applied, or both of those are applied simultaneously, the plot goes down much faster. And it's true, when you run it, then your answers don't really vary from one run to another, and you can trust that answer better. These are the 2 most well-known techniques to reduce your variance, but there are a lot of different areas of research trying to come up with better way to reduce this, right? But if you don't want to do Monte Carlo, then another option that you can do is the standard numerical methods to solving PDEs. Those of you with background in engineering may have seen this. Fast Fourier transform, finite element method, or finite difference method. They're all valid, and they can solve your PDEs. Right? But I want to highlight that finite difference method in mathematical finance is usually very powerful. It's to the point that you can do it in Microsoft Excel. It is surprisingly fast in a split second, and it's very accurate. And the beauty of it being done in Microsoft Excel is you can just send your spreadsheet to other portfolio managers, and they can open it in their own laptops. Right? They don't need specialized computers to do so. So from the 3 examples I explained above, hopefully you can see some benefits of quantitative investing compared to traditional investing. It's an efficient automated process because it's done by the computers much faster than a human being can. People often compare it to the manufacturing revolution for investment process. This means a single manager can handle more funds and bigger funds in each size-wise. That means the management fee that is paid to the investment manager is smaller in terms of percentage of the fund. And that lower expense ratio usually translates to better returns. The computer is obviously not emotional and not impulsive. it tends to not overreact to market conditions, right? And it's really easy to do what-if analysis. So for example, the models, all the new models that I mentioned before, that people come up with new models every day. If today I come up with a new model and I want to know if it's better than my previous model or not, I can go back 3 years before and say, what if I had used this model instead of my current model? And where will I have been today? What are my numbers like if I had used that? Because we have the data from past 3 years and we can easily run the simulations, right? And this is really hard to do if you're a traditional investment manager. It's really hard to think, how much of Coca-Cola would I have bought 3 years ago? Yeah, eventually it's a very hard thing to think objectively. You cannot just say, well, the computer told me to do it. The computer told me to trade it that way. You cannot say that. The manager have to know why the computer decided to do that, to make that trade. So all of this portfolio construction and portfolio scheduling that I mentioned before, the manager has to be intimately familiar with the inner workings of the algorithm to know why the computer generated these trades. Right? We also have a very bad reputation of ruining the market because the financial mathematics really relies heavily on the model being right. So when we're wrong, we're really wrong. Even when we're wrong a little bit, we're wrong a lot. The example is negative interest rate. The difference between negative 0.01 interest rate and positive 0.01 interest rate is huge. Even if mathematically it's small, it means all the difference in how people approach cash balances, for example. Not that our model is wrong at the time, but the market conditions change really fast. And eventually it's intertwined with the global political events. For example, the negative interest rate is so much related to all the political crises that have been happening in the last 10 years. Right? So hopefully by now I have piqued your interest a little bit on how to become a financial engineer. The mathematical skills that you need are statistics, differential equations, and numerical methods. Right? And you need good programming skills in the fields of optimization and data structure. But primarily, you need to know or being able to analyze how fast your program runs. What's the complexity of my running time, right? The brute force approach suffers from just the sheer number of parameters you have to run. As I mentioned before, in the trade scheduling, I can cut down the running time from 6 hours to 13 minutes if I code my program the right way. Right? And this is not sacrificing correctness. If I'm willing to sacrifice correctness a little bit, maybe I can push this down further. But this requires ultimately how is the simulation being run and how do I model my data structure in order to run the simulation. Right? As I said before, financial knowledge is helpful, but it's not a prerequisite. I did not have much financial knowledge before I got into the field. But what is important here is your passion for understanding how the markets work and how you can use mathematical formulas to help you understand how the markets work. I would like to conclude this lecture by giving special thanks to the International Black Sea University for inviting us and for the Seed of Hope for arranging this lecture series.